So, you're looking at your fixed income options. And let's be real, you're probably feeling pretty underwhelmed, right? Finding a truly high yield income vehicle right now, one that doesn't keep you up at night sweating over the risks, is a massive struggle. But what if I told you there's a unique government backed infrastructure play that might actually hit the exact sweet spot you've been looking for?
8.5%. That is the headline distribution yield of the PowerGrid Infrastructure Investment Trust, or PGInvIT for short. Look, in a market where standard savings rates and traditional dividends are just scraping by against inflation, seeing a legitimate 8.5% yield, yeah, that definitely turns some heads.
To really put this into perspective, just look at its parent company, PowerGrid Corporation of India. We all know it. It's a massive Maharatna PSU, a super reliable dividend payer, but it generally gives you around a 3 to 4% yield. PGInvIT, on the other hand, yields more than double that. And here's the kicker. It's literally the exact same underlying power transmission business. It's just structured differently to funnel cash directly to you, the investor. All right, so let's dive into this. Welcome to today's explainer, where we're demystifying the PowerGrid InVIT. We're going to break down exactly how it pulls off this massive yield, we'll pit it against its biggest private sector rival, and most importantly, we're going to uncover the hidden risks you absolutely need to know about before you even think about jumping in.
Part 1. The high yield attraction.
Now, you might be thinking this is just some high yield masking a dying business, but it's really not. It's a growing profit base. Just looking at the Q3 FY26 results, net profit actually surged almost 22% year over year to 283 crore. Revenue bumped up nearly 7% to 612 crore, and EBITDA is sitting real pretty around 520 crore. That kind of momentum tells us their operations are incredibly efficient right now. But hey, if you're an income-focused investor or planning for retirement, growth is just one piece of the puzzle, right? You want predictability. And PGInvIT delivers consistent payouts. They distribute roughly 12 rupees per unit every single year, and that's neatly sliced into 3 rupees paid out every quarter. It's like clockwork. 4 times a year, the cash just hits your account. So the obvious question is, what on earth is generating all this cash? Part 2, inside the asset portfolio. Basically, the trust holds 100% equity ownership in 5 special purpose vehicles, or SVPs. These aren't abstract financial instruments. We are talking about massive, physical, critical infrastructure. There's the Pugalore-Tirunelveli line, which covers a staggering 2,200 circuit kilometers, plus the Pugalore-Kolhapur, Rashpur-Lucknow, Balia-Kashipur, and Rohtak-Ludhiana lines. These 5 massive arteries are absolutely vital for keeping India's lights on. And here is the absolute genius of their business model. It's all based on availability-based revenue. Think of it kind of like a toll road. But imagine a toll road where the government pays you a fixed, guaranteed fee just for keeping the road open and in good condition, even if literally 0 cars drive on it. As long as these transmission lines are physically available to carry electricity, PGInvIT gets paid, period. It is a phenomenally low-risk cash machine. Oh, and this is not some short-term gig. These transmission service agreements are locked in tight, with an average residual life of 27 years. That gives us incredible long-term revenue visibility. You're not sitting there guessing what they might earn next quarter or even 5 years down the line. It is contractually mapped out for decades.
Part 3. Financial health and ratings.
So, with that kind of setup, it's probably no surprise that ICRA recently reaffirmed PGInvIT's credit rating at a pristine AAA with a stable outlook. For those keeping track, in the financial world, AAA is the gold standard. It's the highest possible rating you can get, signaling extreme safety and stability. A huge reason they maintain that AAA rating is their operational consistency. They regularly hit over 98% target availability. How? Well, the parent company, PowerGrid, acts as the project manager, so they bring absolute world-class expertise to running these lines. Consistently hitting that 98% mark means they fully recover all their transmission charges and even bag some extra performance incentives along the way. But honestly, here is the financial metric that completely blew my mind. The regulatory limit for net borrowing in an InVIT is 70%. PGInvIT's net borrowing ratio as of December 2025, just 5.22%. I mean, that is essentially a debt-free balance sheet. It gives them absolutely massive financial headroom. They could easily take on debt to acquire new assets in the future without putting any real stress on their current financials.
Part 4. PGInvIT versus IndiGrid.
So, How does it stack up against the competition? Well, in one corner, you've got PGInvIT. It's PSU-sponsored, holds 5 assets, has a market cap of around 3,036 scores, and offers that juicy 8.5% yield. In the other corner, we have IndiGrid, backed by private heavyweights like Sterlite and KKR. IndiGrid is way bigger, an 11,000 crore market cap and 18 diversified assets, but it offers a slightly lower yield, floating around 7.5 to 8%. Basically, you're weighing the higher concentrated payout of PGInvIT against the massive scale and diversification of IndiGrid. And this creates a pretty fascinating split among analysts. The research team over at Dividend Strike absolutely loves PGInvIT. They see it as the prime choice for conservative investors who just want the highest possible yield backed by a PSU. But then, on the flip side, Prime Investor argues that IndiGrid is actually the smarter bet. Their reasoning? PGInvIT's asset portfolio has basically been stagnant since it listed, while IndiGrid is out there aggressively buying up new assets to keep growing its payouts.
Part 5. Taxes and Hidden Risks.
Okay, let's talk taxes because understanding the composite taxation here is a massive advantage. Unlike standard stock dividends, which, as we know, get fully taxed at whatever your regular income slab is, InVIT distributions are broken into pieces. Roughly 65% is taxable interest, 20% is a completely exempt dividend, and 15% is classified as a deferred capital return. Long story short, this structure makes PGInvIT incredibly tax efficient. It basically means you get to keep a lot more of that 8.5% in your own pocket. But look, we have to talk about the caveats. ICRA actually issued a pretty specific warning. They expect operating income to start moderating from FY 2028 onwards. Why is that? It's due to declining non-escalatable tariffs that were baked into their original government bids. Essentially, if PGInvIT doesn't use all that debt headroom we just talked about to buy new assets soon, their cash flows are probably going to start a slow, gradual decline after 2028.
And just to make sure you have the full unbiased picture, there are a few other risk factors to keep on your radar. There's concentration risk, right? They only have 5 assets. If even one of those lines goes down for major maintenance, you're going to feel it. You also have to consider interest rate sensitivity, since their revenues are largely fixed, potential regulatory tweaks by the CERC, and liquidity risk, because these units just don't trade with the massive daily volumes you'd see with a typical large-cap stock.
So all of this really brings us to the ultimate question you have to ask yourself. Yield or growth? What actually matters more for your specific portfolio? Are you leaning towards PGInvIT's massive, tax-efficient 8.5% payout and that rock-solid, debt-free balance sheet? Or do you agree with the critics who prefer aggressive expansion and diversification, even if it means taking a slightly smaller yield today? Let that thought marinate a bit and decide what makes the most sense for your own investing journey. Thanks for hanging out with me for this explainer, and remember to always keep asking the right questions.